Is the great housing crash of 2023 coming, with interest rates relentlessly skyrocketing and homebuyers leaving the market in droves? Let's take a look. But first, please subscribe to this channel, and if you do, I'll be more than happy to pump out good analysis on a weekly basis. According to the Black Knight Home Price Index, median home prices fell 0.52% in September, continuing a 3-month streak of declines. Annual home appreciation slowed to 10.7%, still more than twice long-term norms. And while indicative of continued correction, the 1.2% decline from August is the smallest seen in 4 months. Despite price corrections, home values in the nation's 50 largest markets remain elevated by anywhere from 19 to 66% since the start of the pandemic. Still, homeowners lost $1.3 trillion in recently added equity in the third quarter, the largest quarterly dollar decline on record, and the largest on a percentage basis since 2009. Equity amongst mortgaged homes is now nearly $1.5 trillion off its May 2022 peak, with the equity of the average borrower down $30,000 from earlier this year. While additional declines may be on the horizon, equity positions remain strong at $5 trillion, which is 46% above pre-pandemic levels, and the average mortgage holder still has more than $92,000 more equity than before the pandemic. Though the number of underwater homes has climbed nearly 275,000 over the last 4 months, more than doubling the population, fewer than 500,000 homes are currently underwater nationwide. Nationally, 3.6% of borrowers are either underwater or have less than 10% equity, which is roughly half the pre-pandemic share. And a historically extremely low share are in negative equity positions. This means foreclosures aren't going to be jumping anytime soon. So what does this all mean? The great crash isn't here yet, and it may not be coming simply because the job market remains very strong and homeowners still have large equity positions in their home. However, it's hard to ignore that after peaking in the second quarter of this year, homeowner equity saw record levels of contraction in the third quarter. In the span of just 3 months, U.S. mortgage holders saw a total of $1.3 trillion in newly acquired equity evaporate. That is by far the largest quarterly decline on record by dollar value and the largest since 2009 on a percentage basis. The vast majority of homes at risk of falling underwater are those that were purchased in 2022 and late 2021 at or near pandemic era peak prices. To put that into context, just 3.6% of nearly 53 million mortgage holders are either underwater or have less than 10% equity in their homes. That's roughly half the share coming into the pandemic. While additional declines may be on the horizon, homeowner positions broadly remain strong. Continued inflation concerns and expectations for another 75 basis point Fed rate increase in November caused 30-year rates to surge to their highest level in 20 years. With 30-year rates at 7.08% as of October 27th, just 133,000 high-quality refinance candidates remain. That's the smallest such population on record. Of these mortgage holders with the refi incentive, almost all of them have a mortgage from 2008 and earlier, which leaves little reason to refinance outside of accessing equity and cashing out on their investment. The highest such share since 1984, and well above the long-run average of just under 25%. The last time affordability was this tight, 30-year rates were over 13%, nearly twice today's offering. Buying power has been cut an additional 14% by rate increases, even as home prices have pulled back from June 2022 peaks, and is now down 38% from the same time last year. Los Angeles remains the least affordable market nationwide, requiring 76.6% of the median monthly household income to make a mortgage payment on a median-priced home purchase. Housing market watchers are split on whether we will see meaningful price declines in coming months or even years, due to low affordability or a more lateral correction moderated by historically low inventory. All in, prices have fallen 2.6% since June, the first 3-month decline since the 30-year rate spiked to near 5% back in late 2018, and the worst 3-month stretch since early 2009. Over that same 3-month span, the median home price fell by $11,500. So are home prices tumbling? No, they're not, simply because of historically low inventory. Although rates are rising, we are instead in a deadlock between buyers who don't want to pay these higher interest rates for less home and sellers who are in no rush or need to sell. This is called the hunkering down phenomenon, which is what home sellers are electing to do. So where do we go from here? No one knows just yet. Rates still have lots of room to move upwards, and as long as the job market remains strong and homeowners have this much equity in their home, there will be no reason to sell at a loss. However, we might be in for some low real estate market activity for the foreseeable future. What are your thoughts? Comment below, I'd love to know, and please reach out if you have any questions about where the market is headed.